this year has been a rolling bear market. People can call it whatever they want to. The average stock is down 20%, right? There's been 20% corrections in various markets all year. So this is not new news to the market. That's the good point, right? What I'm talking about for next year, the market's been thinking about now for 6 months. It's just that the average observer is kind of catching up to where the market's been. So if you think about the near term, we had a shock in October, took out the last bastion of safety, which was growth stocks, some of the small caps. That's good. That means everything is kind of re-rated now. That's where everybody was sort of hiding. And typically when that happens, you don't just go straight back up. So we called for a month ago just to be kind of in this range of 26.50 to 28.25. I mean, does the truce over the weekend or the Fed dovishness change that upper end? Not really, because valuation at 2,800 is pretty full at 16 times.
So it's interesting because you point out what we've seen this year is strong earnings, but valuations shrinking. Next year, it's going to be the opposite. Not the opposite, but valuations stay relatively close to where they are, but there may be a modest earnings recession. So we're left with the same range in the S&P based on different things, though.
Right, different drivers. So, and go back to 17, right? Our call in 17 was we would get multiple expansion, which is why we were very bullish in 17, because the market was anticipating the tax cuts in 17 and some of the good stuff that's now apparent. This year was the opposite. Very good growth, multiple contraction, and so next year we get sort of the blah, which is a very tight trading range on multiples and really no growth. We're not looking for an earnings recession for the full year. We're looking for the risk of an earnings recession for a couple of quarters.
Okay. So you have a bear. If it was a bear, you're talking 2,400 on the S&P. If it was a bull, you're talking 3,000.
Right.
So we stay somewhere in that in that range.
That's a big range, and there's opportunity within that. So that was our call at the beginning of this year, was that we'd be in a 2-year consolidation, 2,400 to 3,000. That's actually held very well. We think that basically continues into next year. Different drivers. If you think about it this way, right? We've been in a 9-year bull market, okay? And if you're telling me that all we're going to do is a 2-year consolidation, that's our punishment, for having run this bull market, that's pretty darn good. So long term, we think we're in a secular bull market, but you still got to consolidate this.
But you
there are a lot
count
of fundamental reasons for that.
You count this as a cyclical bear, though, because of the individual stocks. The averages haven't done 20, but they don't have to for it to be a cyclical bear.
Yeah, I think that's semantics. I mean, look at 15, 16. That was a global recession. A lot of stocks were down 40, 50, 60%, even though the index was only down 15 or 18. Same thing in 2011. We had a 19% correction. Is that a bear market? Yeah, I would say yes.
Well, but that was almost going to be my answer, because haven't you then had like an 18-month stretch of sideways?
Yeah.
So this isn't the first consolidation in a 9-year bull market.
Not at all. And it's very healthy, quite frankly. I mean, in January when we were going into the stratosphere, it would have been very dangerous to continue to see multiple expansion as earnings were going up. That would set you up for a much more damaging type of a decline. If you think about what's going on this year, the market's been very efficient attacking the weakest links first as financial conditions tightened. And I think that's a healthy development. It's a consolidation. There's a rotation going on now. And I think the trick here is to figure out what's going to work in the next leg of the bull market, which probably doesn't begin in earnest till next year. Right. We think it's value more than growth.
And you're going with Flo, not Geico, the lady on Progressive's ads. You like her. You have fresh money list. You like Progressive.
Correct.
You're removing E-Trade and night transportation. You're doing some specific things here, Santoli, for you. And then you're keeping Disney on the list. So keeping Humana, keeping Microsoft, and Occidental, but you're adding, you think people ought to buy Progressive today?
Look, the key thing, yes, we think the key thing looking forward is basically valuation. So it's not so much value versus growth, but the valuation now matters. In a world where real interest rates are going up, and I know 10 years down, but the real interest rate market is going up, I think that you cannot overpay now for growth or safety. Long duration assets in the equity market are under attack.
You know a lot. I mean, do you watch Paulson? Should we listen to him? I mean, what's your opinion of him?
I like Jim.
Do you think he's got some valid?
Good answer, Mike.
Okay, good. You want to ask Mike? What do you think of Mike?
I do have a question for you. There's something I'm concerned about. At this late stage of the economic cycle, and with already concerns around the issue of recession, with credit spreads blowing out, the yield curve inversion, if we have an earnings recession, don't you think there'll be just broad-based panic? No. As opposed to people going, oh, buying opportunity because that means multiple pressure left? I just wonder what you
Absolutely. I think there will definitely be panic on individual securities next year, which is why we think you got to be very careful about overpriced stocks. That's where we think the risk still remains, is in the high price growth stocks. Not growth overall, but high price growth stocks where expectations are too high, they're going to be punished severely.